In this problem, we have a restaurant that is considering whether or not they should purchase a $7,500 worth of souffle maker. This souffle maker has an economic life of 5 years, and it will be fully depreciated by the straight line method, which means every year of the 5-year life, we will allow 1/5 of the original purchase value as depreciation. This machine will produce 1,300 souffles per year. Each will cost $2.50 to make, and it will be sold at $5.25. Assume that discount rate is 14% and tax rate is 34%. Should the company make the purchase? To answer this question, we need to calculate cash flow from assets for each year. Well, year 0, it is simple. We have only capital investment, so negative of the initial purchase. The following years, there is no capital investment or there is nothing on the net working capital, so all we need to do is calculate the annual operating cash flow. For that, we start with the annual sales. We have 1,300 of the souffles. We're going to sell them at $5.25. Cost of goods sold, 1,300 times $2.15 each. And the depreciation is going to be $7,500 divided by the project life. Our net income is sales minus the cost of goods sold minus depreciation times 1 minus the tax rate. But net income and annual operating cash flow are not the same thing because we didn't spend the depreciation as cash. So we're going to add depreciation back to net income. So for each of the following 5 years, annual operating cash flow is indeed the cash flow from assets. The net present value for this project is then using the NPV function, using the discount rate 14%, the future cash flows, plus the initial cash outflow. So this project brings in net present value $3,382.18, which is indeed obviously positive. Hence, we should make the purchase. For the purposes of seeing what our rate of return is, let's calculate the IRR from this project as well. It's $31.53, obviously, which is way, way above our discount rate. Hence, using IRR as well, we reach the same decision.